Okay, good morning, everyone, and welcome to this morning's Coffee Microcaps Morning Meeting. I'm delighted to welcome back any of our regular attendees, and welcome to all our attendees who might be joining us for the first time. My name is Mark Tobin. I'm the founder of Coffee Microcaps. I've got a quick couple of slides to run through before we get into it with our presenter this morning. I'd like to mention DMX Asset Management, our sponsor of the Coffee Microcaps Morning Meeting, who help keep these, through their sponsorship, these events free for attendees. Quick compliance and disclaimer slide. For anyone who is joining us for the first time, we generally have companies on here that are capped under 300 million, are in revenue and approaching cash flow break even, or indeed are already profitable. We generally don't have companies from the resources or the biotech sector. So it's what I say in our industrial microcaps, which could be microcap technology, financial services, healthcare, industrial products businesses, professional services firms, kind of anything basically ex-resources, ex-biotech. Structure this morning's webinar, we're going to have a 30-minute slot, which is going to be breaking down into a 20-minute preso and 10 minutes of Q&A. If you do have any questions for our presenter, please type them in the Q&A box rather than the chat function. Just makes it easier for me to moderate to our presenter at the end. The webinar is being recorded and it'll be posted on the Coffee Microcaps YouTube channel next Tuesday. I'm cognizant of the long weekend, so we'll throw it up early next week and everyone's back on deck. Follow Coffee Microcaps, on all the social channels, Twitter, YouTube, as I said, for the recording, and indeed all previous events. There's probably well over 100 company presentations up on the YouTube channel now at this stage. And without further ado, I'd like to welcome back actually Garry Crole, Managing Director of Sequoia Financial Group, who's going to give us an update on all things SEQ. So I am going to stop sharing my screen, and Garry, if you want to start sharing yours, I'll let you know when I can see the cover slide of your presentation. Okay, Garry, I think we're good to go now. So
okay, thank you. Sorry about that, everybody. Billy, I'm a financial services executive, not a technology executive. I'd like to thank Mark again for inviting Sequoia onto the Microcaps webinar. It's the second time I've been on. I think I was on about 12 or 18 months ago when our share price was sort of 20 to 30 cents. I'm thankful today our share price is closer to 70 cents, and I'd like to discuss the current company's financials and also the future outlook and what we do and why we do it, and where we see the market moving. I'll just go through that quick disclaimer on the second page. Obviously, none of the information I'm giving to you today is personal advice. It's just general in nature. And that's particularly important for us because we are a financial services organisation that is a licensed business who does give advice. So I just thought I would run through that slide a little bit longer than most people do. What is Sequoia? I think when I'm presenting, I'd like to really explain what we do and why we do it for the benefit of investors. I'm always of the view that if you go and invest in a company and you don't know what it does and how it makes its money, that's not a very sage decision. So if all I get out of today is explain what we do and why we do it and how we generate our income, I think I will have achieved a substantial goal of mine. Basically, what we do is we are a provider of a range of services to the financial services intermediary market. The intermediary market is made up of 10,000 accountancy firms, currently 17,000 authorised representatives. That was closer to 30,000 authorised representatives prior to the Royal Commission. So the number of advisors has shrunk dramatically. At the same time, demand for advisor services has increased dramatically. And there's approximately 2,000 AFSL holders that license those representatives. All three of those customers are potential clients of Sequoia. So we're not only into licensing advisors, we're also into providing services to AFSL holders and the 1 million self-directed investor households that qualify under the current sophisticated investor status. Importantly, Sequoia is not primarily a B2C business. We're a B2B business, and those firms that I'm talking about there are our core customers. The services that we provide, unlike a number of other businesses that are listed on the ASX that are considered to be licensees, ours are far more diverse. Whilst we do provide licensing services, we provide what we think is everything that an accountancy firm, an authorised representative, an AFSL holder, or a self-directed investor might need to make the decision to invest or to provide advice lower cost, so more Australians begin to get advice from a financial planner or from their firms. So we provide licensing, we provide a suite of media research. We've got 3 or 4 media channels: Financial News Network, Yield Report, Share Cafe, and so on. We have research. We have 7 analysts in our team. We have educational content. We're doing a webinar every second week to the advice community. We have administration services. We're an ASX clearer, which means that we're similar to what Pershing used to be, for those that understand clearing and execution. So we're competing with sort of open markets, Bell Direct, FinClear, and so on. Our business there is called Morrison's. We have corporate advice where we do capital raisings and raise and do IPOs to the market, and we distribute that through those channels that I mentioned. And we have family office service, which is providing advice, particularly to the international investor that is looking to become an Australian citizen, and if they qualify under the SIV programs, particularly in Asia. We're authorised by Austrade, or we're in the 10 approved Austrade members in the fintech space, and we're the only financial planning group that Austrade has approved, and that's been very positive in the short term that we've been there. The company's structure is we have 132 million shares on issue. We generate approximately $1 million per month of operating cash flow on more than $130 million of revenue. So we forecast $130 million of revenue at the start of at the half year. I can advise that that's likely to be closer to 140 million. And the 12 million operating cash flow, we were operating at about $900,000 per month in the first half. We would expect that we'll be at about $1.25 million per month of operating cash flows in the second half. So we would think that we'd actually do more than $13 million of cash, operating cash flow for the full year 2022. We have no debt, and we have more than $12 million of cash on a clean balance sheet. We've been using our cash to fund acquisitions and to pay secondary payments. So cash is probably about the same it was at the start of the year, but that's because we've used it to pay a small dividend and to also fund acquisitions without diluting shareholders by doing new raises or capital raises. The current share price of around 70 cents therefore represents an enterprise value of about $80 million, or 0.6 times revenue if you're looking at that. But more importantly, from a financial planning or perspective, or an analyst's perspective, we're trading at about 6.5 times full year 22 operating cash earnings, closer to 6 times full year 22 operating cash earnings if you consider we expect to generate $13 million of operating cash earnings for full year 22. I'll just move on. The businesses that we provide, that we have, so I mentioned before, we have 4 divisions and 20 businesses. On a sum of parts basis, there's been discussion that we believe we're undervalued if you looked at a sum of parts and looked at particular assets in particular within the group. So in wealth, we have around 6 businesses. So we have Interprac Financial Planning, Libertas Financial Planning, and Sequoia Wealth Management. those 3 businesses are licensing advisors as third-party providers to provide advice to their clients. There's about 400 advisors there. Interprac Security is where we employ advisors, and we purchase retiring advisors' client books and then employ an advisor in-house, a younger person, to service that particular client and grow that particular business. And it's a good opportunity for us and for exiting advisors to work with us for sort of the last 2 or 3 years of their career after selling their business to us, and that's been working very well. We have a number of potential acquisitions in that space, but we've been quite careful because one of the challenges is there's not enough advisors out there to employ, or there's not enough advisors out there to service the community. So we're finding it a little challenging finding enough people to come in and help us transition the old advisors to new advisors. So the industry's got a little bit of a challenge there, that there's too much demand for the supply, which is a positive thing for shareholders, but it's a challenging thing for the industry. We have a corporate finance arm, as I mentioned, family office, and that's the wealth division. That makes up about 40% of the revenue. And there's been a number of sales take place in that particular area. And generally speaking, the sales have been coming in at about 2 times gross profit. If you looked at that in isolation for us, the market cap of Sequoia is actually not far different to that as a standalone. The professional services division is primarily where we deal with accountancy practices, a little bit of financial planners, but not so much, but more so accountancy practices opposed to AFSL holders and planners. And what we do there is we do self-managed super fund administration on behalf of the accountancy firm. We set up company documents such as company structures, trusts, family trusts, SMSF setups, and so on. And we've got 3,000 accountancy firms there that use our service. And we also do insurance broking. I'll move along because I talk too much. I'm probably going to run out of time. The equity markets business is the Morrison's clearing business. That's been a standout business for us. We've invested a lot of the company's capital back in 2019 to build capability, and now we're seeing the rewards in that. That business has been growing extremely strongly. In the last 12 months, the market volumes have turned down. However, the Morrison business has not turned down. The Morrison business continues to grow at exceptional numbers and is actually now very profitable. There's been discussion of open markets and FinClear coming to market at a valuation as a standalone business much higher than the Morrison business is within Sequoia. So that's on a sum of parts basis, that is something that's a bit of a standout for us, but we are absolutely committed to this particular business and we are growing it. And our pipeline of new AFSLs looking to join us is very significant. And then the direct business is that media and the robo advice businesses that we have. I'll move along. Just touch on the financials for the half year and give a little bit of guidance for the full year. So EBITDA was 5.5 million for the half, which was up 38%. The second half, we expect the EBITDA to come in around 7.5 million. So we would think we'll be closer to $13 million of operating cash profit EBITDA. The positive thing about the Sequoia EBITDA is that it matches cash. So the DAR component of us is basically only writing down the value of the companies that we've acquired over time. But the reality is, whilst we're writing them down from an accounting purpose, each one of those entities is actually growing and probably more valuable than it was prior to applying the accounting DAR. So that's extremely positive for us. Revenue, we forecast that would be close to $130 million for the full year. I'm now advising that that's likely to be closer to $140 million. So we're having a strong second half in the first 3 months. And instead of $1 million per month of operating cash flow, I'm expecting that to be $1.25 million per month in the second half, getting us towards that $13 million EBITDA number that I'm suggesting we will land at. The fully franked dividend was ½ cent in the first half, because the second half is likely to be $7.5 million opposed to $5.5 million. The second half dividend will definitely be stronger than the first half, but very importantly, we're going to keep our payout ratio at around 25%, because we're not looking to issue new shares or dilute shareholders. We're looking to use the cash to continue to make acquisitions, and we have numerous acquisitions that we're looking at across all 4 divisions, actually across 3 divisions. Morrisons doesn't need any acquisitions because it's already got complete capability, and market share is just organic. But the other 3 divisions, certainly there's opportunities for acquisitions, and we're looking to pay 4 to 5 times cash earnings using cash to do that. Current share price is a little bit out of date, is actually 70 cents. So the enterprise value is $78 million. So enterprise value is approximately 6 times, which we think is undervalued. And obviously shareholders and investors make that own determination. But if you look at our peers and you look at the market and current interest rates, to be generating 6 times cash flow, I think is a very good investment. Move on. I think I've probably covered most of this, but clearly, if you look at all the financial metrics in the first half, all of them are positive. That's continued. Revenue in the first half was a little bit higher than last year because of a number of factors with some of our investments, which I explained at the half-year period. But you'd be confident to say that we will clearly outperform our full year 21 numbers in full year 22, and we will surpass the forecast we made of 15% growth on revenue, and we will surpass the forecast we made of more than $12 million of operating cash flow. So from that perspective, the business is going really well. It's too early to call, but April, May, June are always our strongest months, and at March accounts, we're looking very confident in our results. We'll go to the next slide, Mark. The wealth division, as I mentioned before, the goals are probably important. We would like to go from the current 400 advisors to 800 advisors under those licenses. I would expect half of that to come from organic growth, half of that to come from acquisitional growth over the next 3 years. The market pricing has increased a little bit, so there's been a couple of transactions of recent time where other listed companies have acquired blocks of advisors. The prices that they've paid is probably higher than we would have liked to pay. We're looking to pay 4 to 5 times earnings. The risk is that you buy an advisor group like that and the advisors leave. So if you're paying more than 4 to 5 times earnings, in our opinion, that's too high. So we would rather just grow organically or wait until the right opportunity comes along, and then reward those parties with equity in the business, and hopefully they become part of what we come and they get their upside through our increased share price, rather than us paying too much for an acquisition. We certainly will, as I mentioned before, look to acquire retiring advisors' practices in our salaried business. We have around 15 advisors in the group doing professional years at the moment. So one of the points I made before about not enough new advisors coming into the industry, we're looking to address that. The professional year program is a new initiative by the regulator, where new advisors must do a couple of years of learning before they become authorised, and we've got programs to allow those parties to come through that process, and some of those will end up in our salaried area. Others will end up within our network, working for financial planners within the group. Clearly, we want to grow funds under advice, profitability and market share. Next one. Professional services. This is a This is the accounting area. This is a big margin business for us. We made an acquisition approximately 4 months ago, I believe. The legal practice of a new entity, which is Top Docs. So Top Docs Legal, Top Docs business itself was sold to Class Super, which Hub bought for, I believe, $13 million. We bought the legal entity that provides the documents, and we're seeing a lot of new business come to our documents business as a result of having the very impressive and very skilled legal staff now working for us in that particular area. There's a lot of traction for self-managed super funds to update their trust deed with the rule changes. There's a lot of people with family trusts and normal trusts looking to make sure that their trusts are actually up to date. A lot of people buy a trust and leave it for 10 or 15 years and have an expectation that the trust doesn't need upgrading. It absolutely does. So we're providing a service there. And we're also seeing an increase in demand post-lockdown of people setting up companies, trusts and super funds, because new businesses appear to be on the growth. Our business there is looking at recording a potentially 50% increase in turnover in this particular 12 months. So the number of accountants and the number of trusts each one of those, or companies and trusts and super funds each one of those are setting up, is definitely increasing dramatically. So that particular business is doing extremely well. And we will look to make some acquisitions in that area as well for our self-managed super fund business. I'll move on to the next slide. Equity markets division is the Morrisons business. That business has been happening for 2 years, continues to grow. I mentioned before that the market volumes of the ASX may not have continued to increase through lockdown as they have, but that has not impacted the Morrisons growth. The 88% growth in revenue for the first half 21 continues. So we are continuing to see record turnover. We're not in the same game as, say, open markets and FinClear in some ways, in that we don't participate in the discount to the race to the bottom on fees. We're looking to have every single AFSL that we use as a profitable client for us. And the average trade size that Morrisons does is almost $100,000 per ticket. So we're in the distribution of, we're in the financial services game, not the day traders game of lots and lots of trades at a very low cost. We're providing a service at a premium cost and a premium service, and more AFSLs are joining us, and the volumes that they're generating continues to increase. We actually are the #1 options clearer, and our growth on equities is continuing to increase. We're looking at more products, such as increasing our international side, and we're also potentially looking at, we're seeing what happens in the crypto ETF space, but the requirements for capital in that area appear to be very high and probably not worth the risk from a clearing perspective at this stage. But we are looking, and if the requirements from the regulator come down to a reasonable number and there's enough demand, we will certainly consider it. Move to the next one. And the last division of the 4 is the media. That was our most recent acquisition with Share Cafe and Foreign Investor and Corporate Connect. And, you know, we're really excited about those. We won't see any impact on our numbers for this particular year, I wouldn't think, as we settle it down. But I would think that we'll see some strong growth in that area. So, you know, we can't afford this business to be a $2 million per annum division. We want it to get to $10 million per annum over the next few years, but have good margins. In summary, at the end. So I think I've covered it, but one of the things that we've talked about is we have around $12 to $15 million moving up and down a little bit as we make acquisitions and use the cash for further acquisitions, but we've just been approved and going through the process of documentation for a facility for up to $15 million for acquisitions. So that would mean that we've got a bigger pool, and we definitely will not be coming back to the market to raise capital if we were looking to buy a much larger business. So we'll have a much bigger cash bank to deploy for acquisition. So that is particularly important. So cash is $12 to $15 million. The share price at 70 cents is about six times. And I think that the company's opportunity is better than it's ever been, because the ageing population and the transfer of $3.5 trillion of wealth with not enough advisors to advise the community places us in a tremendous position to support the industry of those 10,000 accountants, 17,000 advisors, and 1 million self-directed investors with our services. And demand is strong, and as I mentioned before, supply is weak. So it's a good position for us to be in. So I'm happy to take questions, Mark, if that's where we're at.
Thanks, Garry. We have a few from the audience, but I'm just going to say if we don't get through them all, Gary's email address here for anybody who might want to reach out to Garry for a one-on-one, or if you've got follow-up questions, or to be as simple as get on their distribution list for whenever they're sending out IR communications. If you want to maybe join that, you can email Garry directly. But let's take these questions up first, and there's actually another one coming in now. In the licensing division, Garry, what's the risk that a licensee contravenes the law and this having a contagion effect on Sequoia's kind of multiple licenses?
No, it's a good question. I think it's the greatest risk of all licenses is having a breach with a regulator. One of our arguments is that there's 2,000 AFSL holders, and unless you've got scale, you actually haven't got the real ability to provide all the services that are required by a licensee. We have the best, in our opinion, compliance staff. We have the best practice development managers. We have quality educational parties. We have investment committees. We have no alignment to product. And the only reason we can have all of those and employ high caliber people with 10s and 15 years plus experience in licensing and support to advisors is because we've got scale. So I think there's some risk, but I think we protect the risk by employing the right people, having a really difficult enrolment process or engagement process for an advisor. So if an advisor calls us and wants to become licensed under our license, they've got to make application to us and we've got to approve them. It's not the other way around where we're out in the market just looking for the next advisor because it's all growth. It's all about quality for us. And whilst we do want to grow because the scale and the service that we provide is the premium service, and the advisors that are at the premium end want to join us because of that, and we're selective. So it's a risk, but it's not one that I would think is at the high end compared to the market.
Another question, I think you kind of touched on it in your presentation. Open Markets has been reported to be up for sale. Does it present any strategic value to combine it with Morrison's, or is Morrison's and Open Markets kind of playing in kind of two different spaces you kind of alluded to on the kind of the ticket sizes?
Yeah, no, we would we definitely would not be looking to acquire Open Markets. We believe we've got the infrastructure and service capability to compete against them in a profitable manner. From my understanding is they're not making a profit, and we're more likely to encourage their clients to join us for a rather than acquire them.
Okay, and then the next one, Sequoia, I think it plays in the structured products area. What exactly are these products, and is Sequoia taking the principal risk on these products, or are there other counterparty risks? I think that's Sequoia Specialized Investments, if I'm correct.
Yeah, absolutely. So Sequoia absolutely does not take any prime risk whatsoever. We have 6 international banks that we currently work with. So, the likes of UBS, Citibank, Deutsche. So there's top international banks. What we do is we come up with a thematic or an investment proposition that we like. We then go and price it out to the market to get the best possible deal that we can. And then we market that particular thematic to our client base. The structures are very simple. It's basically just protected options. So an investor might invest $10,000 for $100,000 of exposure to a particular market over 2 or 3 years. The absolute maximum loss that the investor can have is that $10,000, and their return is whatever the return is on that $100,000. Obviously, with gearing, you've got to outperform the cost of the investment. But what we're doing there is we're trying to come up with a thematic that we think is positive, price it at a reasonable number, but most importantly, reduce the capital risk to the client by having no call on the investment. So, structured products over years and years have been challenging because people get too clever. The ones that we're looking at are very, very simple and just using some gearing and some protection to allow some people to get into a particular thematic. And, we've done 100 odd over the last 4 or 5 years, and our performance has been very, very good.
In the longer term, which countries have the best fit for SEQ for, a possible overseas expansion?
I don't know the answer to that one. I think we're an Australian business. I think it's more likely that someone from overseas wants to acquire Sequoia than Sequoia wanting to go overseas. The distribution power that we can have by servicing, the Australian market completely, 10,000 accountants, 17,000 potential advisors, and the 1 million self-directed investors is the whole Australian market. So if we're providing services to that whole Australian market, that's big enough for us. But certainly if an international global bank or someone wanted to come in and get a foot into that market, and we didn't lose our independence as a result of that, because that's very important to us, it's more likely to be the other way around than us going overseas.
Just conscious of time, Garry, but let's just squeeze in this last one if we can. The acquisitions, how do you identify targets and kind of conduct the analysis and due diligence? I think you kind of touched on it. It's more kind of dealing with inbound inquiries rather than it's a very outbound focused acquisition strategy.
So there's two parts to that. So from the advisors joining the wealth business license, there's a bit of inbound and outbound, but more inbound, where someone's heard about Interprac or Sequoia's licenses and they're wanting to become authorised by us. So that's inbound, and that's not acquisition. But on the acquisition side, that's me and my team actually more outbound. So we know what we're looking for, and which parts of our business we're looking to grow. And I absolutely make the first approach and find the businesses that we think would be an ideal fit for us, and then make an approach and see if we can encourage or we can take advantage of an opportunity of putting 1 and 1 together to create 3 for us and the shareholders of the potential business that we're looking to acquire. Where someone's just looking to sell and move on, that's where we give cash. But the most attractive investments for us is where someone wants to be part of a bigger business, like the Share Cafe and Corporate Connect acquisition of recent time. The 2 founders of that particular business are now significant shareholders of Sequoia, and they've joined our management team, and they will help us drive the direct division. So it's very important for us to focus on EBITDA and also find the right people to help us grow our business from being a $100 million revenue business to sort of a $1 billion revenue business over a long period of time. So I've talked previously about 400 million by 2025 as our revenue target. To get that, we need good people, because it's people who run businesses, and part of the acquisition strategy is to find the types of people that we attracted at the most recent acquisition.
Gary, I think we'll leave it there because we have gone slightly over time, but thank you very much for coming in and giving us an update, and we will watch with interest announcements coming through on the ASX on further developments with SEQ.
Thank you very much for everyone for listening, and thank you, Mark, for the opportunity.
Thanks, Gary. And with that, I'm going to end this morning's meeting, and wish everybody who celebrates this coming Easter festival a good weekend, and enjoy it all. And we will be back the end of the month. There won't be a Coffee Microcaps meeting next week, just FYI. We're going to hold over until the following week for when all the Appendix 4Cs will come out. So watch out for a series of events happening that last week in April. Have a good weekend, everyone.